Ladies and gentlemen, good day and welcome to the Indian Railway Finance Corporation Limited Q3 FY21 earnings conference call, hosted by DAM Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amitabh Banerjee, Chairman and Managing Director of IRFC. Thank you, and over to you, sir.
Thank you, and good evening to everyone. Well, just to give a snapshot of the company that we had given last time during the road shows, IRFC has been registered with the RBI as a systemically important non-deposit taking NBFC with a infrastructure finance company status. And this is majorly now owned by Government of India with about 86% shareholding, and rest 14% has been divested recently by way of an IPO. Now, this is the dedicated market borrowing arm for the Indian Railways. This remains so post-IPO too. And the primary business of the company is financing the acquisition of rolling stock assets as well as railway infrastructure assets and projects of national importance, and giving these assets on financial leasing terms to Ministry of Railways for a specific period of time, after which, after the expiry of the lease period, the ownership of these assets are transferred to Ministry of Railways. Besides lending to Ministry of Railways, besides lending to the sovereign, IRFC also lends to the other SPVs of the Ministry of Railways like RVNL and IRCON. If you look at the AUM breakup, about 54%, 53.6% to be precise, is accounted for by the lease receivables from the rolling stock assets, and 44% is by way of lease receivables on account of project assets, and only 2.1% is on account of loans given to other SPVs, as I just mentioned. The total AUM is of the order of 2.97 trillion rupees to end of December 2020, and it has been registering a CAGR of 26.8% over the last 3 years, with effect from FY 2018 to end of December 2020. The net worth as it stands on 31st of December is 32,734 crores. 32,734 crores. The return on equity is 9.31% for the 9 months ended December 2020, and on a yearly basis, it translates to 12.41%. Return on asset is 1.01% for 9 months and 1.35% on a yearly basis. There is no NPA in our books. There is no tax liability of the company, and we are a zero tax company as on date. The total debt portfolio is of the order of 2.57 trillion rupees. The net interest margin is at 1.06% for the 9 months, and which translates to 1.41% on a yearly basis. We have rated at par with the sovereign as far as the international credit rating agencies are concerned, and the domestic credit rating agencies rate us at AAA and A1 plus for the long-term and the short-term tenor papers, respectively. The capital gearing ratio as of now stands at 7.86 times the net worth, and the capital adequacy ratio is at 433.35%. Going to the next slide, the key strengths of the business, as I mentioned earlier also. Just to recap, it plays a strategic role in financing the growth of Indian Railways and has financed 45% in the last financial year, that is ending 31st March 2020, and in the current financial year, we are slated to contribute about 47% of the total capital outlay requirements of 2,40,800 crore. Our total demand from Indian Railways to IRFC now stands at north of 1,13,000 crore. We enjoy a very competitive cost of borrowing on the back of highest credit rating from the domestic credit rating agencies as well as the international credit rating agencies. And we have diversified funding sources from taxable and tax-free bond issuances, term loans and structured loans from banks and financial institutions, external commercial borrowing, by way of bond issuances and syndicated loans from international agencies, and so on and so forth. It's a low-risk cost-plus business model. It's a low-risk model primarily because of the fact that all the receivables from Minister of Railways, that is from the sovereign, is a part of the union budget, and therefore it is totally Government of India guaranteed. The entire, almost the entire income or the turnover of the company is totally is laden with very low risk because it is guaranteed by Government of India. And as far as the cost-plus business model is concerned, all the costs incidental to lending and borrowing are passed through to Government of India, including the cost on hedging of the ECB portfolio. There's a strong asset liability management in place. We try to dovetail the long-term loans that we are taking from the market with the long-term tenure of the assets that we are funding to Minister of Railways. These two are dovetailed so that there is no asset liability mismatch. And there is a particular covenant in the standard lease agreement that we enter into with Minister of Railways every year. That covenant states that in case of any liquidity situation facing us at the time of redemption of our liabilities, Minister of Railways will pitch in with the requisite amount of liquidity so that at no point of time IRFC stands in a position of being failing to honor its liability commitments. Although we have never had the occasion to invoke this particular clause because we have never had any kind of an asset liability mismatch due at the time of redemption of our liability, both by way of redemption of bond as well as repayment of principal on the structured loans. IRFC has been having a consistent financial performance over the years, with the net profit growing at a CAGR of 26% since the last more than 3 years. And it's having a very low overhead and administrative cost at only about 0.14% of the total revenue. And we are aided by a very experienced senior management team. Going to the next slide, as you said earlier, IRFC remains to be a systemically important NBFC, and since our major client happens to be the sovereign, therefore we are enjoying certain regulatory exemptions by way of asset classification norms and provisioning norms of RBI, exposure norms, as well as credit concentration norms. We are given an exemption, except the 2.11% of our AUM, which is accounted for by the direct loans that we are giving to the SPVs, since they are not sovereign. Therefore, these norms are very much applicable to the loans given to these SPVs. We are, as of now, we are totally a tax-free company. We are outside the scope of 115 JB of Income Tax Act 1961, under which we used to pay minimum alternate tax. But with the adoption of 115 BW of Income Tax Act, with effect from 2019, September 2019, we have become a tax-free company with effect from FY19-20. We are also exempt from the applicability of GST on all the leasing of rolling stock assets. Going to the next slide, this shows the update on the 9 months quarter ending December 2020. The revenue from operations is 3,932 crores for Q3, and the total revenue from operations to end of December 2020, that is for the 9 months, is 11,315 crores, and the profit before tax of the PBT for Q3 is 1,046 crores, and the total PBT to end of December 2020, that is for the 9-month period, is 2,933 crores as compared to 2,537 crores last year. So there is an increase of 15.65%, and so is the case with revenue from operations also. It has gone up from 10,215 crores in the corresponding period last year to 11,315 crores for the 9 months ended December 2020, registering an increase of 11%. Going to the next slide, this shows the key ratios. The net interest margin is 1.606% for the 9 months, with an annualized rate of 1.41%. The return on net worth is 9.31% for the 9-month period, with an annualized, which is annualized to 12.41% per annum. Interest coverage ratio is 1.23 times, Debt equity ratio as of now, as I said, capital gearing ratio is at 7.87 times net worth, and the capital adequacy ratio is 433.35%. We have declared an interim dividend of rupees 1.05 per share, which amounts to 10.5% of the face value of rupees 10 per share. That means we have declared a total dividend of about 1,380 crores this year, the interim dividend amount. The next slide shows the borrowing highlights. During this financial year, we have issued 20-year bonds in the domestic capital market at an annual coupon of 6.85% for an aggregate amount of 10,643 crore. And we have also recently issued a $750 million Regis 144A bonds at a coupon of 2.80%, which is one of the tightest in the recent times, which is about 55 to 60 basis points lower than the rates that our peers have raised money from in the international market in the recent times. And another important point was that we have priced this inside the secondary market yield of IRFC by about 9 to 10 bits. Amount raised to long-term rupee loans is of the order of 31,550 crores this year from the banks and financial institutions, with a moratorium period of, which includes a covenant of a moratorium period of 5 years and a repayment period of 15 years, repayment period of 10 years. So the total tenor of the loans is 15 years, having a moratorium period of 5 years. Going to the next slide, this shows the ratio of funding from various sources. About 47% of our total funding is through the domestic bonds, the domestic taxable bonds, followed by 30% by way of rupee term loans from the banks and financial institutions. 12.39% of the total portfolio is accounted for by the tax-free bond that we had issued some time back, and 9.67% of the total portfolio is by way of ECB. We are getting the AAA ratings from the domestic rated agencies, namely CRISIL, ICRA and CARE, and the international credit rating agencies like Moody's, Standard & Poor's, Fitch, and Japanese credit rating agencies rate us at par with that of the sovereign. Going to the next slide, this shows the strategic role that the Indian Railway Finance Corporation has been commanding over the years vis-a-vis our financing of Indian Railways capex requirements are concerned. It has gone up from as low as 19% in FY 2015 to about 47% this year, which is about 1,13,000 crore out of a total of 2,40,800 crore this year. And as far as FY 2022 is concerned, that is the next financial year, we have been given an initial mandate of 65,200 crores as against 58,000 crores that we were given last year. And the total capex requirement of Indian Railways this year is slated to be about 2,15,000 crore. The next slide shows the share of the total population of the rolling stock of Indian Railways, which happens to be under the ownership of IRFC. Roughly about 80% of the total rolling stock assets of Indian Railways are owned by Indian Railway Finance Corporation. They have been financed by Indian Railway Finance Corporation and given on financial leasing terms to Indian Railways. The total value of rolling stock assets, which we have financed as on 31st of March 2020, stands at 2,23,810 crores. Now, as far as the financing, the business model of IRFC is concerned, this has already been mentioned to you earlier. So just to have a recap, the rolling stock assets, we are giving them on financial, we acquire these rolling stock assets and give them on financial leasing terms to Ministry of Railways for a period of 30 years, comprising a primary period of 15 years and a secondary period of 15 years. We get the entire lease rental in the initial period of 15 years, and after the expiry of 30-year lease period, the ownership of these assets are transferred to Ministry of Railways. And we are getting the advanced lease rentals from Ministry of Railways every year in biannual installments. For the period from April to September, we get in the month of April, and for the period from October to March, we get the lease rentals in the month of October. and we charge a margin of 40 bips over the all-in cost. That is the weighted average cost of the incremental borrowings that we are doing in a particular financial year. Over and above that, all the costs are added to arrive at the all-in cost, and we add 40 bips to arrive at the lease rental payable by Ministry of Railways to IRFC. The weighted average cost of borrowing to IRFC has been coming down over the years, as evidenced by the fact that in FY 2019, the weighted average cost was at 8.09%, which came down to 7.37% in FY 2020. And for the 9 months ended December 2020, the weighted average cost has come down to 6.4% in this financial year. As far as the financing of project assets is concerned, the business model remains the same, with the only exception being that the margin is 35 bips as compared to 40 bips in case of rolling stock assets. And then you come to the income statement. We have already, this has been already circulated to you. You'll just have a look, and I have already mentioned to you the major parameters. That is, the total income has risen to 11,315 crores this year, this 9-month period, as compared to the corresponding period in the last fiscal, that is, which was over 10,215 crores. It has increased to 11,015 crores with an 11% increase, and the PBT has risen from 2,537 crores in the corresponding period last fiscal to 2,933 crores in this fiscal, in the 9-month period this fiscal, with a 15.65% increase. I think that comes to the end of the presentation. I'm open to questions, if any. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Shri Ram Prasad, individual investor. Please go ahead.
Hello, sir. Good evening, and
Good evening.
congratulations on your listing. I
Thank
have a
you.
few questions, sir. We noticed that the CRAR is 433%, while the NBFC mandate is, I think, if I'm not wrong, at 15%.
Yes.
So what was the reason to raise 3,000 crores of equity capital when the CRAR is extremely comfortable, especially when risk-weighted assets will not grow because, like you said, because of sovereign risk, the risk weight will be extremely low. So I just want you to give some color on the reason for the equity raise and keeping CRAR so high, or going ahead, you will not raise equity and you will let the borrowings grow and bring the CRAR. So I just want something on that aspect. And in light of the same thing, what would be the dividend policy going ahead? Because you need not retain much earnings to keep up your equity base. So will the dividend policy be, what would your dividend policy be going ahead? That is my first question with respect to CRAR. My second question is with respect to how is this spread priced between the government of India and you? Because you said that it is 40 BPS. And I remember also seeing that the NIMs are at 1.4%. So how does this 40 BPS translate into 1.4%? That is something, a calculation I'm not clear. So these two questions, sir. I'll come back in the queue for my further questions. Thank you, sir.
Well, thank you for those interesting questions. Number one is that, yes, we are having a very high CRAR, primarily because most of the assets under management are all zero risk-weighted assets. And the only risk-weighted assets that are included in the calculation is the asset under management that pertains to RBNL and IRCON, which is only 2% of our portfolio. So definitely it is about 433%, which is much higher than the mandated one. But coming to the question of that what was the need of raising this equity, this is primarily because of the fact we are an NBFC and we have to, and the mandate from the borrower, that is the sovereign, is increasing by leaps and bounds over the years. As is evident from the slides that I have already circulated to everybody. You see, if you look at slide number 9, you will see that at one point of time we used to just fund 19% of the total capex outlay requirements, and now it has grown to about 47%. And going further, the requirement will definitely go northward. Now the point is that we have got a policy of having a capital gearing ratio of 10:1, and we generally hover around that particular percentage. So,
what is the ratio you mentioned? Sorry, I didn't hear it.
The ratio is 10x. Basically, we have a ceiling of 10x as far as the capital gearing ratio is concerned, right? Okay. And now we are at 7.78x. We are comfortably placed, but most of the time we are hovering around 10. It is either 9.5 or 9.6. Now, how I came all of a sudden to 7.78? That was primarily because of the fact that last year, when we were given an exemption in 2018 from the provisioning of DTL, the deferred tax liability, we had a reserve of about 6,500 crores in the DTL, lying in DTL. And then last year, Minister of Corporate Affairs had allowed us to include this amount as a part of our net worth. Previously, it used to be a part of our liabilities. Now it has been included in the net worth, and that has actually helped us in having a leeway as far as the capital gearing ratio is concerned. That has brought down the capital gearing ratio from about 9.6 earlier to now at about 7.7x. So we still have some amount of money. But main problem is that I need to have the requisite net worth to mobilize the funds required in order to serve the Minister of Railways, especially the mandate that they are giving us. Now, the initial mandate that Minister of Railways has given us in FY 2021, that is in the current financial year, was only 58,000 crore, right? Now, this 58,000 crore has jumped by more than 100%. Now, by about 100%, it has gone up to about 1,13,500 crores. Now, where do I get? Unless I have the requisite, equity base or the net worth, I won't be able to garner that much money from the market. So therefore, and another important point is that since my margin, as you know, is only 40 bits, because it's a risk-free business model, you are not having any kind of a NP in our books. Naturally, it also comes with a lower margin from Government of India. So with something like 12,000 crores of and the total net worth as of now is about 32,000 crores, but comprising about 12,000 crore of equity and 20,000 crore of reserves and surplus. With that thing in view, unless I have the requisite capital infusion, I won't be able to mobilize that amount of money. So that is the reason that we were required to go to the market and raise equity, so that we have the necessary capital gearing to enable us to raise the requisite amount of money from the market to serve the demand from Minister of Railways in this particular fiscal. Coming to this, and the number two question was no. The number two question was regarding 40 bits and the NIM, the variation between this. How does it translate to? That is primarily because of the fact that, yes, you're absolutely right. That's a very, very good question that you asked. Because of the leverage that we get from because we are not only giving the money to Minister of Railways, or we are lending to Minister of Railways not only from the loans that we are raising from the market, but also from the equity infusion that has been given by Minister of Railways, as well as our reserves and surplus. Therefore, and since they did not come with any attendant cost, so that actually adds on to my NIM, and that is why that actually accounts for the variation between the NIM and the margin that we are taking from, obtrusively that we are taking from Minister of Railways. Yeah, your follow-up question.
I think my second question is clear, sir. The first question is the capital gearing at 10x. Is it a matter of regulation or is it a matter of policy?
It's a matter of policy. There is no regulation which forces me to remain within 10x. But right from inception, and as per the market, convention also, we've generally been keeping ourselves to within 10, to be more on the, conservative side. We don't want to actually, because, being an NBFC, we have to look at the ALM position very, very closely, and we don't want to spread this too thin. So we feel that 10x is the right kind of a gearing that we should go by going forward. But yes, there is no such limit on this, and if the occasion so arises, there is no such. As far as the lending agencies are concerned, there are certain lending agencies who are quite comfortable also with a 15:1 ratio. That they have also, as per their approval, they have already given an approval for that. But having said that, we want to keep it, as a matter of policy.
The reason I ask is essentially capital gearing is a measure of risk, right? And so is the the CRAR, and our CRAR is comfortable. So I think we can go slightly easy on the gearing because CRAR is so high. But anyway, that's a matter of policy. So I'll join back in the queue. Thank you for clarifying.
Thank you. Thank you.
Thank you. The next question is from the line of Siddharth Gupta, AS Stockbroking. Please go ahead.
Good evening, sir, and congratulations on your listing and such a fantastic set of numbers. Sir, my question actually carries forward from the first question that was asked with regard to the dividend policy, sir. Because as it was mentioned, going further, even if I'm assuming that the cost, even if the cost that the government requires you to raise over the next 10 years doubles or triples, the actual processing cost would still remain the same. So what would be the company's dividend policy going forward?
Well, you see, the dividend policy would be determined on a year-to-year basis. Now, as far as we used to generally have a dividend policy of about 10 to 15% of our PAT. That used to be the dividend payout generally. But with effect from this financial year, not with effect from this financial year, for this financial year, we have taken a decision duly, in consultation with DIPAM as well as DPE, that is Department of Public Enterprises, that this year we should be following the policy as enjoined by DIPAM and the Minister of Finance. So there is a specific DIPAM guideline on dividend payouts by all the public sector enterprises, and we are abiding by the same guidelines. That is 30% of PAT or 5% of net worth, whichever is higher. So we are abiding by this particular principle as far as FY 2020-21 is concerned. And accordingly, we have, under that only, we have decided to come out with this interim dividend payout.
Right. So, and my the second question that I had, I'm sorry, that's the last question I have. So, with regard to the rolling stock assets and further the assets that the company owns, are they housed in different subsidiaries or are they housed by the company in itself? My question is generally based on the fact that would in the future, would possible private investment into these subsidiaries to kind of act as, say, pseudo InvITs, if I can put it in that way, is that something on the anvil, or is it simply completely owned by IRFC in their own hands?
Yeah, it is completely owned by IRFC in our own hands. We don't have any kind of a subsidiary, and as far as InvITs is concerned, that is for the Minister of Railways and IRFC to take a call later on. If at all. As far as the monetization of assets is concerned. But yes, as far as the ownership of these assets are concerned, there is no such subsidiary in place, and it is entirely owned by IRFC as of now.
Thank you so much.
The entire stock. Yeah.
Thank you. The next question is from the line of Swati Makkar, individual investor. Please go ahead.
Hello. Sorry, it's Naman Kumar. Thank you for the opportunity, and again, thanks for the effort, IRFC management, for providing detailed information in its annual report as well as the IPO documents. I have 3 basic questions just to understand the business more appropriately. It's not related to the quarterly numbers. Like, my first question is, because we don't have tax liabilities, because we have higher tax rate or tax depreciation, So I just want to check what is the tax depreciation in the Income Tax Act we claim on rolling assets. And then the second question is, till date, whatever the liabilities sitting on the balance sheet, what is the average weighted average cost of all the liabilities, not just for 1 year or 2 years, like combined all the liabilities. And my third question is if the management can throw more color on the recent reconciliation which happened with the Ministry of Railways accounts, and that resulted in some restatement of accounts. Thank you.
Okay. Now, as far as the tax rate is concerned, we are now governed by 115 BAA, that is the normal corporate tax rate, and we have an unabsorbed depreciation, which is more than the computed tax, and therefore the net taxable, which is more than the net taxable income, and therefore the net taxable income comes to below zero, and therefore the tax liability, the question of tax liability arising does not arise. I mean, it doesn't really arise with effect from FY 2020. So that is as far as the tax position is concerned. As far as the rate of depreciation on rolling stock and other matters are concerned, that will be dealt with by one of my colleagues. And number 3 is regarding this, as a result of some reconciliation that we had with the SPVs, that is the RVNL and IRCON, we have saved certain, I think it's about 1.2 crores odd that we have, that has come to our revenue. We have saved by way of interest. And that was on account, these are all, on account of some discrepancy by 1 or 2 days, which has gone to the advantage of Indian Railway Finance Corporation. And as far as the rates are concerned, Mr. Ojha can throw some light on the rate of depreciation on rolling stock assets and so on. Ojha, please take over.
Yes, thank you so much giving me an opportunity. So the rate of depreciation on rolling stock is 25% annual basis, and this is charged in 2 ways. That is, from if rolling stock assets are acquired from 1st April to 30th September, then whole 100% depreciation, that is 25% is charged. And rolling stock acquired from 1st October to 31st March, it will carry 50% of the required rate, that is 12.5% of 25%.
Yeah, just to correct on one figure, this income tax rate on depreciation for rolling stock is 15%.
15?
15%.
Okay, not 25. Okay, fine.
No, not 25. It has been reduced.
Okay, thanks.
Okay. Number 1. And number 2, sorry. The other question was, what is the weighted average cost as of now? Of all the loans put together. Yeah. I remember that question. Yes, Ojha, what is the, or are you having that figure?
Yes, sir, till December 2020. So average cost of my total outstanding borrowing is 5.28%.
5.28%, okay. Samantha, you were there?
Yeah, 5.28% for the 9 months. So I can just throw it for the 9 months.
No, not for the 9.
Yeah. No. This is till 31st December.
Till. The question is, what is the average cost of borrowing? Not the weighted average cost, the average cost of borrowing to end of December 2020.
This is 6.4% from 1st April to...
No. That is from 1st April.
This is 5.28%, sir.
5.28%. Right.
5.28% for the 9 months ended December 20.
Exactly. 5.28% is the answer.
Yes.
Right.
Okay, got it. This is helpful. Sorry, Amitabhji, one more question on that reconciliation thing. I understand the 1920 annual report showed a PAT of 3,700 crores, but post-reconciliation in your final IPO document, that got revised to, I think, 3,100 crores. So there were some 500, 600 crores reconciliation.
Yeah, that was on account of some prior period adjustments. Which was already explained in the last meeting. In fact, it was already explained in the RHP, And I think, it was already explained there. It was primarily because of the package adjustments on account of certain entries to be done between Minister of Railways and IRFC.
So it was not for 1 year. It's like all prior year, 4, 5 years.
Yes, absolutely.
Okay, this is really helpful. Thank you. If I have more question, I'll come back in queue.
Thank you.
Thank you. The next question is from the line of Alok Shah from Monarch Networth Capital Limited. Please go ahead.
Thanks for the opportunity, and sir, congrats on great set of numbers. And sir, also thanks for putting out this detailed presentation on how the numbers have moved through. But a quick request, it's more of data points that I'm trying to understand here. Sir, can you put out, help us with the number on disbursements that we've done YTD? Would that be readily available?
The disbursements are of the order of, the total disbursement is about, more than 3.75 lakh crore. Correct me if I'm wrong, 3.75 lakh. It is more than 3.75 lakh crore. The total disbursements that we have done to end of December 2020. 3,75,000 crore.
Okay, and how would this number look like, say, for the same quarter last year?
Yeah, as far as the disbursements are concerned, it has been going up pretty significantly over the years, and especially over the last couple of years. So, it's about 3,75,000 crore to end of December 2020. Then it will be nearing, it will be more than 4 lakh crore in the next financial year. So therefore, it is going to go up. As of now, we have another 65,000 crore disbursement mandated in FY 2022. So, as compared to 58,000 crore initial mandate that was given in the last financial year. So that is a 7,000 crore increase. And this last year, 58,000 crore got revised to 1,13,567 crore. So this year also, we don't know what the final numbers would be, but the initial numbers are 7,000 crore more than the corresponding period last year. So, and especially since you must be aware of the fact that there is a National Railway Plan (NRP) which is in place for 2030, which mandates that almost about 10 lakh crore would be spent on capex in the current decade, and to make railway future ready for up to 2050. Therefore, there is a lot of role. There is a significant role that IRFC would be playing towards this capex program of Indian Railways. And even for 2024, there is a rail vision plan of 2024, which mandates about 2,45,000 crore of capex outlay. So we will again be forming a major, playing a major role in this this capex program too.
So okay, this helps. And just a bookkeeping question again. You mentioned that weighted average cost of borrowing for first 9 months was 5.28%. That's right?
No. That is 6.4%, and 5.9% is the total average cost of all the loans that we have that stand on in our books on date. And for the 9 months, the marginal weighted average cost is 6.2%, as compared to say 7.37% last year, the entire year.
Is it marginal cost of borrowing is?
The marginal weighted average cost of borrowings for the 9 months ended December 2020 is 6.4%. And the total total liabilities that are in our books that fetch a return. The average cost of the funding of all those is about 5.25%, whatever was just now mentioned.
Okay, this is it. I'm done with my questions, sir. Thank you so much. Thank you.
Thank you. The next question is from the line of Shri Ram Prasad, individual investor. Please go ahead.
Hello. Thank you for giving me an opportunity again, sir. When the government and you decide together what the spread should be, is there a consideration of what the maximum ROE the company can make? Is there something like that sort of a discussion happening, sir, or what factors determine how the ministry and the company agrees on a spread?
You see, the spread is determined, is a consequence of negotiation between MOR, Minister of Railways, and IRFC on a year-to-year basis. Every year this is negotiated. Now, what are the factors that determine the spread is, number one is that the viability of the underlying projects or underlying rolling stock assets. So that, as far as the Minister of Railways is concerned, they take into account the viability of these projects, and accordingly the cost of funding has to be commensurate, so that the viability of the underlying assets by way of rolling stock and project assets is maintained. So from their side, they have got certain kind of a benchmark as far as the markup is concerned. As far as IRFC is concerned, the thing is that we have to see that our net worth is built up, by way of accretion to reserves and surplus. So this is basically a trade-off between the two forces, and we come to an amicable agreement on this. Yes, definitely it is not comparable to the going market trends of markups, but the point is that we are in zero NPA company. It is a totally sovereign guaranteed kind of a the income of the company. The entire income practically is guaranteed by sovereign. So keeping all those factors in view, and keeping also the factor in view that it is a volume game that we are engaging in, we are dealing in huge volume. So therefore, even with a limited spread, we are able to generate enough surplus. And with a very asset-light company and with the kind of very low cost-to-income ratio that we have, this is one of the lowest in the world, with a very slim staff strength. So we are trying to leverage these strengths to advantage, and even within apparently low markup, we are able to generate a substantial amount of revenue, which goes to strengthen our net worth. And since we are an NBFC, we have to ensure that the net worth is on a continuous increase, is on a continuous rise. Otherwise, we won't have the wherewithal to raise the requisite amount of funds from the market without again going to the market for further equity infusion into our network. So these are the various dynamics which actually play out while arriving at a particular date. But having said that, it has been a general trend, to have a uniform kind of a rate, and so that every year we don't have to revisit the same kind of dynamics year in and year out. Yeah.
Thank you. We'll take the next question from the line of Yusufi Lakshmidhar from Apex Investment Consultant. Please go ahead.
Yeah.
Hello. Yes, sir. I just want to know your dividend policy. You mentioned paid 30% or I will not.
5% of net worth, whichever is higher.
5% of net. Okay. Okay. Fine. Okay. Thank you.
Thank you. The next question is from the line of Harshvardhan Agarwal from Infina Finance. Please go ahead.
Hi, sir. Good evening. I
Hi.
just wanted to confirm the disbursement we did in this quarter. If you can share that number, please.
In this particular quarter, that is September to December?
Right.
Yeah. Ojha, can you just throw some light on that?
Mr. Ojha, please unmute your line from your side.
Yes. Actually, we have my revenue from operation is 3,923 crores as against the corresponding quarter.
No, the disbursements only. Only the disbursements. कितना disbursement किया है हमने Minister of Railways को? I'll tell you something. I've got some rough figure. You see, the disbursement that we have done is to end of 31/12/2020 is of the order of 34,000 crore. 34,000 crore.
This is in the 9 months.
In the 9 months, yes. And yet to be disbursed is about 67,000 crores or something. Yes. Yes. But as on 13 to, no, just 1 minute, please. Yes. But to end of 13th of February 2021, we have disbursed 46,751 crores.
Okay.
Already.
Okay.
To end of 13th of February, we have disbursed 46,751.57 crore.
Right. So, sir, if I understand it correctly, you said 34,000 crores have been disbursed in the first 9 months, and 19,000 crores were disbursed in the first 6 months. So basically, that 15,000 crores is what we have disbursed in the first quarter.
Yes. I mean, it's about 23,000 crore. 13,000 crore that we have disbursed in approximately 1.5 months.
Okay. And sir, if you could share the same number for for September 19 to December 19 quarter.
Well, that will be difficult to. But you see, it all depends. I'll tell you, the raising of funds is absolutely dependent on the indents given by the Minister of Railways. So as soon as the indent is given, we immediately disburse the funds. It is not like that they have already placed the indent and then we scour for funds or scour for loans. No, they are already in place. I mean, we already have these loans sanctioned by the commercial banks in place, and as soon as we get the indent, immediately on the very same day or the following day, we disburse the amount because we have the funds readily available.
Right.
So, because otherwise it will entail negative carry from our side, which will be not in the interest of the company.
Right. And so just one last thing. So just to confirm, let's just say we have a target of around 70,000 crores of disbursement for the next fiscal year. Is that?
65,000 crore.
Yeah, 65,000 crores. So is it that this 65,000 crore will be equally spread during the 4 quarters?
No. Generally, the bulk of the demand over the years we have seen comes in Q4, and even in Q4 also it comes in the in the last couple of months and principally in the month of March. So that is, it is not evenly spread. No, it is not evenly spread.
Oh, yeah.
It is. Yeah.
Yeah, that answers my question, sir. Thanks.
Yeah.
Thanks.
Thank you. The next question is from the line of DN Shah from SFPL Global Trade Wings. Please go ahead.
Yeah, thank you for the opportunity and congratulations for the listing and good numbers. Sir, I have two questions. You had mentioned that the National Railway Plan has plans of about 10 trillion rupees by 2030, and Railway Vision Plan is something like 2 lakh 50,000 crores or something.
Yes.
These two things are this National Railway Plan includes this 2 lakh 40,000.
Yes. The 2,45,000 is a subset of 10 lakhs. Yes.
Okay. So that was the first question.
Yes.
Second is, sir, we have a completely risk-free model, so it's a very safe model.
Yes.
But then, I just want to understand that do we also get any opportunity for any margin levers or increasing the ROE? Because, if we have this 35 BPS is there or 40 BPS is there, which is our return plus our return on net worth. So is there any way we can earn anything extra over and above this, or that's not possible?
You see, as I told you, the NIM is much more than that, primarily because of the leverage that we consume as well as our reserve surplus. Since they are not having any attendant cost. So therefore our NIM is in the range of 1.4%. But going ahead, we also have plans of diversification, and once that happens, then probably the markup will also rise. But that would be, it is yet to be seen that what would be the percentage of our AUM as far as those lendings are concerned. But IRFC has got the mandate to lend to any sector which has got a backward and or a forward linkage with Ministry of Railways. So we can lend to other sectors also, which goes towards enhancement of the freight or passenger earning capacity of Minister of Railways, we are absolutely having the mandate to lend to those sectors also. So going forward, there is a lot of scope. Yes.
Understood. And sir, one more question, if I'm permitted. Whatever money you raise through bonds, I'm not talking about raising through banks where you can withdraw as per your requirement, but bonds which you get the money, but the disbursement, let's say, happens subsequently down the line. In between, you might be investing somewhere, and there is some other income generated on that. So that other income generated is over and above this 40 BPS, or that's already factored while calculating this 40 BPS?
No, other income. You mean that? How do I manage the resource gap? That just in case. So
yeah. Whatever means you have extra resources which you might be investing in money market funds or whatever government safe asset. So whatever income that is generated is also factored into this 40 BPS, or that comes over and above 40 BPS?
No, that is over and above 40 BPS.
That is over and above.
Yeah. In 40 BPS, it is only the cost of funds plus 40 BPS. Cost of raising funds and the 40 BPS.
So whatever
other income.
Yeah, surplus funds you have till you deploy, till you disburse to the Ministry of Railways.
That is separate.
That is separate, and that gets added to the P&L of the company.
Yeah.
Okay, understood. Thank you, sir. That answers my question.
Thank you.
Thank you. The next question is from the line of Piyush Kherada, individual investor. Please go ahead.
Good evening, sir. Thanks a lot for giving the opportunity. My question is that going forward, whether you will be following the DIPAM guidelines of 30% of distribution of income as a dividend, or it may change, or it might be possible that you may reduce the dividend rate.
You see, at this point of time, I would not really venture any kind of a guess on that particular issue, because as far as we go from year to year, as far as this year is concerned, we have decided to go by the DIPAM guidelines and in consultation with DIPAM and DP. And going forward, we will again have the consultations and then we will take a call on that.
Okay, thank you, sir.
Right.
Thank you. The next question is from the line of Rikhav Shah from Zero Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity.
Yeah.
One question is, I'm still not able to understand why the income is exempt, and I'm not able to understand the section. So can you just put it in a layman's term why income tax is exempt for us? And my second question is, does the cost of capital matter to us? Because our revenue, our margins are fixed. So whether we raise capital at 6% or 8%, we are still only able to earn 40 bips or 30 bips. Does it really matter to us? And my last question would be, what was the idea to raise equity when you are distributing dividend? On one hand, you are raising equity. On the other hand, you are distributing dividend. Wouldn't be a good idea where you can reduce the issue price rather than issuing capital at 26 and then distributing dividend?
Okay. Was regarding, I'm sorry.
First question was regarding the exempt of income tax. Why?
You see, about 3 years ago, we used to pay tax at 56%. You'll be surprised to know, which can comprise majorly 35% on account of DTL and about 21% by way of MAT. Now, in 2018, we were exempt from DTL provision because more than 75% of our lease was from the sovereign. Therefore, we were exempt from the provisioning of the DTL under Ind AS 12. Right? Then in September 2019, we were given the option of opting for Section 115 BAA instead of 115 JB that covered the MAT provision. So we opted for 115 BAA instead of 115 JB. So therefore, the MAT provisioning of 21% was also dispensed with. We are not exempt from tax at all. Please don't get that wrong impression that we are exempt from payment of tax. We are very much subject to the normal. We are very much subject to the. Please.
Yeah, just to interrupt, sir. So whether in future years will we be liable to pay income tax?
Yeah. The answer to the question is we are always liable to pay income tax as per the 115 BAA of income tax as is concerned. Now, why we are not paying tax, that is the question. Since we have a very substantial amount of unabsorbed depreciation in our books, therefore our net taxable income becomes sub-zero. And going forward, since my future asset procurement will be, will be on an upsurge in going forward in the coming years, this unabsorbed depreciation balance will go on accumulating over the years. And therefore, what will happen is the liability of the probability of paying tax is that much, low. And it is surmised that in the years to come, say in a decade or so at least, we won't have to pay any kind of a tax because of this particular provision. So we are not exempt from payment of tax because of the income. I mean, as per the Income Tax Act and the provisions they are under, we are not. Our net taxable income is coming to be zero, less than zero or zero. So that is the reason that we are not paying any tax, and going forward also, the possibility is very bleak.
Right. And my second question was the cost of capital.
Yeah. Cost of capital in the sense that...
So whether we raise funds at 6% or 8% or 9%, matter to us?
No, it doesn't really matter to us, except the fact that the IRR varies. The internal rate of return varies. That is all. So whether we raise it,
and what is the possibility that the Ministry of Railways can arm twist us? And last year they gave us only 30 bits, and maybe they won't give 30 bits and later in future also. What is the possibility?
No, No, it was not last year. It was in 2018 that it happened. It was just once in the last 34 years of its existence that it was reduced to 30 bits. That was primarily because of certain headwinds that Minister of Railways had faced as far as their freight traffic was concerned in that particular year. So they were not able to, have the thing. But going forward, the possibility of any further reduction is almost ruled out. Number one, and number two is the basic reason for that is that it is not in the interest of Minister of Railways to reduce the bits, because in that case, the demand of IRFC for further equity infusion that much, gets exacerbated, and therefore the demand gets exacerbated, and therefore Minister of Railways would be then, asked to fund more by way of equity infusion. So it really doesn't really serve the interest of Minister of Railways in decreasing the bits. If they decrease the bits, our accretion to reserves and surplus that much goes down, and therefore I'm not able to build the net worth that is required to fund again Minister of Railways. So it's a sort of thing which actually would be counterproductive to the interest of Minister of Railways. So therefore, it will not be in the interest of Minister of Railways to further decrease the bits.
Okay. And my last question was regarding what was the idea of raising equity when in earlier years we were only distributing around 10 to 15% of our free cash flows, and this year we decided to distribute dividend to 30% plus of our cash flows. So what was the idea of raising capital?
No. Idea of raising capital. No, the point is, of course, the idea of raising capital I've already discussed earlier.
These are just distributing dividend.
No, I understand. I understand. I'm coming to that. Now, as far as distribution of dividend is concerned, this was a joint decision of the Department of Public Enterprises and DIPAM that no further. In this year, especially when we are going for IPO and other factors also, that no special dispensation will be given to IRFC as far as payment of dividend is concerned, because we were getting special dispensations from DIPAM for from these guidelines, from dividend payout guidelines. But this year, this has been expressly, decided by DIPAM in consultation with Department of Public Enterprises of not giving any kind of a dispensation to IRFC as far as dividend payout is concerned for this financial year. That is FY 2021. So accordingly, we have gone ahead.
Okay, sir. Thank you very much, sir.
Thank you.
Thank you. The next question is from the line of Naman Kumar, individual investor. Please go ahead.
Hello, thank you. My question is with regard to the LIC extra budgetary resources deal, which was supposed to happen between 2015 and 2020. I believe the amount raised was estimated to be 1,50,000 crore, but due to some LIC regulations or insurance ADA regulations, LIC could
exposure
not
norms. Exposure norms. We call it exposure norms. Yes.
Exposure norms. Yeah. So, what is the outcome as of today? Like, how much finally did we borrow from LIC, and how did we meet the remaining shortfall? And by any chance, did this have any adverse impact on the IRFC business?
Okay. As far as that, the MOU, there was an MOU between Minister of Railways and LIC drawn in the year 2015, starting from FY 15-16 to FY 19-20. The total amount of disbursements by way of issuance of IRFC bond would be of the order of 1,50,000 crore. Now, since Minister of Railways cannot directly take from LIC, so obviously IRFC had to issue the bonds to LIC. LIC would subscribe to those bonds. Now, at the end of March 2020, the actual borrowing was only to the tune of 20,500 crores. This was primarily because of the exposure norms of 20% of the net worth. That is as per the IRDAI guideline. LIC could not subscribe to bonds beyond that limit. So that is why it was restricted to 20,500 crores. And going forward, I mean, that MOU has expired in March 2020. And the shortfall, whatever was there as far as project funding was concerned, it was roughly around 71 to 75,000 crore. That was met through from structured loans from the banks and financial institutions primarily. And it had no adverse impact as far as the the proposition of IRFC was concerned. And since it's a cost plus business model, so even if it entailed more cost, the entire cost was passed through to Government of India, and there was no adverse impact as far as the financials of IRFC is concerned on account of that.
Thank you very much. This was helpful. Thank you.
Yeah, thank you.
Thank you. The next question is from the line of Pankaj Kedia, individual investor. Please go ahead.
Yeah, good evening, sir. Thank you for taking so much effort to explain your business model. Based on your understanding of the railway capex going forward, can you throw some light on how would your AUM grow in the next 4 to 5 years from the current 3 lakh crores?
Well, as I said, that the total disbursements has been really galloping ahead at more than 35% on a CAGR basis. So it's very difficult to really do that. But then the AUM will be really will be going ahead pretty, at a very good pace, especially with the NIP, that the national NRP, National Railway Plan, that is in place. And since EBR, the extra budgetary resource funding of Minister of Railways, happens to be a very major part that would play a major part in the capex funding is concerned, and IRFC happens to be the major source of funding as far as EBR funding of Government of India is concerned. I think the growth in AUM would be quite substantial in the years to come, at least in the next decade.
So would it be fair to assume that on a conservative basis, a 20-25% growth in AUM is quite possible?
Yes, I think so. Because, out of, say, I'll give you a small instance. In the last 5 years alone, there has, out of total AUM of, say, about 2.67 lakh crore to end of March, approximately 2.67 lakh crore. 2.22 lakh crore was alone this AUM grew in the last 5 years, from 15-16 to again. So that speaks volumes about the growth in AUM. about the CAGR of AUM in the recent years. So therefore, your estimation is not, is not far from the truth.
Thank you, sir. Another question is, if I look at your net worth and if I look at the dividend policy, and if we add the 20-25% kind of an AUM growth, it seems that the current policy of a 10x gearing will restrict your growth in your AUM going forward, maybe after 1 or 2 years. Is that a fair understanding?
Yeah, yes, it depends upon the final mandate of Minister of Railways on IRFC, because that is a very important factor. That what is the mandate? If the mandate is the leapfrog, then of course it will be, then we have to come to the market, because anyways we have to come to the market for uploading 11% in the next 3 years, and hopefully we will try to manage our net worth by these issuances. That anyway we have to do as per SEBI guidelines. We have to upload 11% in the next 3 years. I think that
but that won't impact your net worth, because that would be an offer for sale from the ministry. So
yes.
It may not impact your net worth much.
It may not impact my net worth much. I totally agree. So let's hope that. It depends. If the mandate is more, then of course we have to come out with fresh issuances.
So if you look at the current borrowings which you have done, and you would probably have some covenants of restrictions on the gearing ratio, would that be a stumbling block if you at some point of time choose to increase the gearing ratio from 10 to 15 or 20?
No, there's no stumbling block as far as this has been a stated policy of the company. There is no such regulation. There's no regulatory constraint as far as increasing the gearing ratio from 10 is concerned. But as a matter of abundant precaution, and as a matter of prudence, and as a matter of the market trends that we have as far as our peers are concerned, most of them they go by this 10:1 kind of a ratio as far as capital gearing is concerned. So there would not be any kind of a constraint as such. But yes, as you are saying that, yes, going forward with the kind of mandate that we are faced with in the coming years, we might have to go for the further issuances from the market.
So that means that even if you maintain a high dividend payout as per the DIPAM guidelines, etc., if the Railway Ministry chooses to go for a very strong capex based on what we read in the newspapers, then your network would not be a issue in terms of borrowing more.
Would not be a constraint.
Thank you, sir. Another last question is, how do you look at the borrowing plan going forward if you need a substantial increase on your AUM? Would you be largely relying on the existing lines which you have from the banks, or if you would be exploring more borrowing from EPFO, etc.?
Yeah. You see, the point is that generally it depends on the market dynamics. We go to the market, we mobilize resources from the domestic market or the offshore market, depending on the market dynamics. Like in the current financial year, we leveraged on the liquidity flush that we had in the domestic market, and we raised as much money as possible. Of course, depending on the mandate from the Minister of Railways. But as of now, about 47% of our total borrowing portfolio is accounted for by the domestic bond, the taxable bond, and only 9.67% is ECB. So going forward, we might have to take recourse to more of ECB. We have got a plan of going for a substantial ECB this year of around about more than 4.5 billion USD. We already raised $750 million USD recently at a very, very competitive rate. It was 2.8% coupon rate, which is one of the tightest in the recent times. And we also propose to go for further issuances in the offshore markets by way of bond issuances under 144A and Reg windows in the remaining part of the year. So
do you hedge this borrowing which you borrow from the ECB side?
Yes, we go for selective hedging. We don't entirely hedge the money, otherwise we will not be able to get the advantage of a low rate in the international market. So for that, we have a risk management committee in place in the organization at the very apex level, and we are guided by a very professional agency in this regard. And whatever amount of ECBs are to be hedged by way of interest rate swaps or currency swaps to hedge the interest rate fluctuation risk and the currency fluctuation risk. We take a call on those, and we just do it selectively based on requirement, so that the advantage of a low rate is passed on to the government to the extent possible. And since all the risks are anyway passed through to Government of India, so it would not have any kind of an adverse impact on the financials of IRFC as far as hedging cost is concerned.
Okay. And so since IRFC is also, as you mentioned in the call, is looking at diversifying its model into areas where there are linkages to railways.
Yes.
Would you look at the capex which would be done by the private sector in this regard?
Yes, absolutely. We are open to that. So some of the private players, especially those who have just to the RFP floated by the Minister of Railways recently for operation of high-speed trains on certain routes, about 150 pairs of trains. They are already in talks with us for financing their rolling stock requirements. And since it has got a direct link with Minister of Railways, so we are open to considering those aspects also. But having said that, we have to also ensure that the viability of their projects is absolutely in place. Since we have a no NPA record, so we need to be we will be extremely circumspect as far as lending to the private sector or lending to other sectors are concerned. So all those aspects would be looked into in finer details, and then we will take a call on how much and when to lend to the other sectors, to the sectors other than the sovereign that we have been lending to heretofore.
Okay. And sir, lastly, this the 40 basis margin which you enjoy, is that renegotiated or looked at on a normalized annual basis, or it's a long-term thing where you have a comfort zone of 10-15 years?
Yeah, I mean it's a long-term thing, but technically it is decided every year. That's the point.
Okay.
So if we need to revisit, we can revisit every year. There's no problem on that score.
Okay, sir. Thank you so much for patiently answering all the questions.
Thank you so much.
Thank you.
Thank you. The next question is from the line of Alok Shah from Monarch Networth Capital Limited. Please go ahead.
Yeah, sir. Thanks for the opportunity and for the detailed discussion here. Two quick things. You mentioned an AUM of something like 2.96 trillion. And the growth therein is 26.8%. Is that the right number for this quarter?
Yes. Over the last 3.5 years. 3 years, 9 months, yes.
Right. Okay.
That's
and in terms of disbursements, you mentioned that the first 9 months disbursements are at 34,000 crores, which is gone up to something like 47,000 odd crores for first 9 months. And what's the target for FY21?
Not first 9 months. Not first 9 months. To end of 30th February.
Yeah.
I mean 3rd February.
Any disbursement target that you have for entire FY21?
The mandate for FY21, the revised mandate for FY21 is of the order of 1,13,000 crores. 1,13,567 crores to be precise. And we have already disbursed 67,000 crores out of that. 46,007. About 47,000 crores we have already disbursed. So yet to be disbursed is roughly around 55,000 crores, which is very much possible in the remaining days.
Okay. And on the FY22 disbursement, did you make a mention of any numbers, sir?
Yeah, 65,000 crores has been given as an initial mandate.
Right.
Out of a total capex requirement of capex program of 14,000 crores in the next financial year of Indian Railways, and that is the initial target. Let us see how it pans out over the year.
Sure. Okay. This helps, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of DN Shah from SFPL Global Trade Wings. Please go ahead.
Yeah. Thank you for the opportunity. I have a couple of follow-up questions, sir. So one is this, your BPS decision of 35 or 40 basis point, which, it gets decided technically every year, although it may remain same. So when does it get decided?
At the end of the year. At the end of the financial year.
So for financial year 22, it will get decided in March month of 21?
Yes.
Okay. So second question.
No, for financials, no. The point is, the bits that will be charged for 2021 will be decided after 2021. I mean, at the end of 2021, in the March of 2021.
But sir, we already started booking the income.
Yeah. It is assumed at that level.
Okay, so that
because
so
generally,
if the BIP changes in March month, then the last quarter will have a substantial P&L.
The entire year will accordingly be reset.
Understood, sir. Thanks a lot. So second question is that we discussed about the hedging, that some portion we hedge and some portion is not hedged, based on the on the guidance of the professional firms and whatever is filed by the company.
No, the risk management committee is there. I mean, it's not the professional. The risk management company, because
Yeah, what I understood was that the hedging cost is already passed on to the Ministry of Railways.
Yes.
Now, suppose if there is some risk because of the unhedged portion, that risk is also passed to the.
Absolutely.
Okay, also passed to that.
Yes.
Okay, sir. Yeah. Thanks a lot, sir. That answers both of my questions.
Thank you.
Mr. Shah, does that answer your question?
Yeah, that answers my question. Thank
you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Ms. Anuja Dige for closing comments.
Yeah, thank you. On behalf of DAM Capital, we thank IRFC management for giving us the opportunity to host the call. Thank you, everyone, and have a nice day.
Thank you very much, everybody. Thank you. All the best.
Thank you. Ladies and gentlemen, on behalf of DAM Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.